Interest is just any payment made for the use of money. So if I borrow money from a bank, money that I have to pay in order to borrow that money is called interest. You get charged a percentage of what you borrow, or a percentage of what you loan. Let's say that I borrow $1,000 at 6%, so 6% is the interest rate. So if I hold that $1,000 loan out for a year, I'd owe $60 in interest. So that $60 would be the fee that I would have to pay to have access to that $1,000. You calculate interest by multiplying the percentage rate times the loan balance. Where it gets a little bit tricky is when you have, let's say, a car loan that you pay once a month. So if I had a 6% car loan, I borrow $10,000, what I would do to calculate my interest, because I have to pay it every month, is I would calculate the balance at the end of each month, and then I would take the 6% annual interest rate, divide by 12, the number of months, and multiply the 0.005, the 0.5% times that balance. That's how much interest I would pay that month. And so every month I would do that, and that would tell me how much interest I'd be paying. If you have money in a savings account or a CD, they will pay it on some predetermined schedule. Like, for example, most savings accounts will pay interest once a month. The federal funds rate is the rate at which banks borrow from one another. So every day, banks either need a little more money or they have excess money, and so they lend it to each other. An adjustable rate mortgage is a mortgage where the interest rate varies periodically. Okay, so it's more risky to the borrower than a fixed rate mortgage, because if I borrow money, let's say for 30 years at 5.5%, even if interest rates go up to 20%, I still only have to pay that 5.5%. Whereas with the adjustable rate mortgage, it goes up over time. However, interest rates typically, although not always, are lower on an adjustable rate mortgage. The very simple answer is to pay off your credit card every month. It'll do a number of things. Number one, it'll build your credit rating. You won't have a history of having late payments and ruining your credit rating, and it'll also make it easier to borrow money when you actually need to borrow money. One website that I'd like to use is a website called bankrates.com. It can oftentimes tell you who has lower interest rates on things like car loans, mortgages, and other types of loans. Bankrates also will tell you where you can get higher rates of return on things like CDs and savings accounts.